Tuesday already. It's lattes with a shot of mortgage. So get your coffee out. Ignore the latter. We're in middle of renovations of the home office. So I got chock full of information. Let's try and keep this under 15 minutes for you because I know you've got a lot going on. So I'm always cognitive of that. So first of all, mortgages, they're holding pretty steady. If you saw yesterday's newsletter, they're right within range of where they were last week. So they didn't move, which is fantastic information. The next Fed fund meeting is in December. I believe it's December 14th and 15th. We do anticipate that the Fed is going to raise the Fed fund again. It's just going to be a matter of what are they going to do. So there's a 50-50 on this one. Half of the analysts think that the Feds are going to come in very light on how much that they raise the Fed fund rate by. And if they do come in low, it's because they're finally acknowledging that we do have all these recession indicators and that we don't need to be super aggressive and cause massive unemployment. And then there's the other half that are really on Jerome Powell's side, where they feel that we need to be really aggressive and really push that Fed fund rate up. So that's going to negatively affect interest rates because that would affect the mortgage bond market. So we just got to keep watching those things and see. I don't think that we'll see a lot of movement between now and December on mortgage rates. And it's because most investors are just pretty much just sitting and waiting to see, because that December Fed meeting is really going to be a big indicator of what we move forward with. So what I wanted to talk to you about was bulletproofing your transaction. I have talked to numerous real estate agents that have said that recently they have had massive amounts of fallouts on contracts. And we're seeing that on new housing, which makes sense on new housing because people were getting under contract, not locked. They don't qualify at the high interest rate. So we're seeing a huge fallout on that side of it. But we're seeing a lot of buyers falling through for 6 big reasons. And, if you read any book like Shift, which I think Gary Keller wrote that one in 2008 when everything was shifting, a lot of those reference points are still really valid because those 6 issues are the same things that we're seeing right now outside of new construction. So here are the 6 things that typically are causing escrow to fall apart right now. It's inspections and appraisals, or inspections and repairs, appraisals, loan approval and funding and crappy loan officers, contingencies issues, sellers agents, and of course, we're seeing a lot of deadline issues. So let's talk about how, as either a buyer's agent or a seller's agent, how you can help to make sure that when you submit a contract that is bulletproof, that you are going to truly close, your clients are going to get a home, and you are going to get a paycheck. So the most common thing is inspection and title problems. So let's talk about title problems because that's a different kind of animal. So maybe your sellers have some liens, or maybe they have an issue with the HOA. Maybe the HOA is currently going through a lawsuit. There could be numerous reasons why there's a lien against the property outside of your client's first mortgage and maybe even a home equity line of credit mortgage. So when you typically meet with your sellers, of course, you're asking them, what kind of liens do you have? A lot of times people just don't understand what liens are. So for example, let's say that they get solar put on the home. They might not realize there's a lien against their house for the remaining balance of that solar panels that got put on the house. Or they might have borrowed some money from a friend in a large amount, and that friend was smart enough to go down to the courthouses and file a lien against the property to ensure that they get paid their portion of what was due. So there could be numerous things that happen with title, and you have to take it by what's going on with the title. So HOA problems, those are a showstopper. If the HOA is currently in a lawsuit, maybe they're a lawsuit against a repair person. One of my clients, it was a lawsuit against the person that had done the siding of their condo. So they wanted to sell their condo and buy a house. and their HOA was in an active lawsuit against contractors. The sellers didn't realize that that meant that they had a lien against their property until title was looked at after getting a buyer. And then they had to find somebody that would agree to purchase this, going totally private lending, non-normal mortgage, because nobody can lend in the middle of a lawsuit that needs to be settled. How the seller's agent should have handled that is that they should have had title pulled when they did the listing. They should have reviewed the title. They should have really gone through it, made sure that the judgments make sense, the liens make sense, make sure that there's everything good with the HOA board. Reach out, ask questions to the HOA board, already find out who to contact for the lender side. How much are the HOA fees? When are they paid? How often are they collected? Any litigations, lawsuits, who is their insurance writer on the house, all those kind of things. Those are great things to do as a listing agent that will bulletproof your sale to go through, because you will know if there's issues, and then you can work through, how do we fix these? If it's a buyer side, buyers get, of course, they get their personal title check. So when you purchase something like a home and there's a lien going against the property, they check your title as a buyer. So that means that they're looking if there's any personal judgments against that person. If they had gone a long time with unpaid child support, there could be a lien against their personal name. If they had served time in jail and had a prison restitution to repay, there's a lien against their physical title. And that's what the title is called. And I've ran across quite a few different scenarios where it didn't pan out great for the clients. So one that we ran across was that the client had spent time in prison, and so they did have a restitution to repay. And that restitution was really big, and they couldn't pay it before closing. The problem is, clients on the lending side, they don't tell us that they have a judgment. They are signing paperwork in their application saying that they have no judgment. I don't think anybody even reads those questions, so I don't hold it against them. But the problem is that we don't see that there's a judgment until they're actually under contract and we get the title reports for them from title and escrow. We can't pull those early. So where lies that problem comes in, where things pop up. One of the other issues that I ran into a couple of years back was a client did have unpaid child support, but because of the loan program that they had, we could go back to the seller and ask for a concession. And then that was actually used to pay the judgment, so that when the house filed, the judgment was paid and clear so that the bank had first position. Why that matters is, let's say that your client has a judgment against them for $150,000 for a car accident. And then they purchase a house and they owe $300,000 on that house. Then for whatever reason, they go into foreclosure, they walk away from the house, and the bank picks back up their house and the bank sells it. And let's say the bank only sells that house for $400,000. Well, out of that $400,000, the bank doesn't get the loan paid first. Whatever lien was filed gets paid first. So in this case, $150,000 would be taken out of the bank's profit or the bank's sale amount money, and would pay the client's judgment off, even though they're in foreclosure. Then the mortgage would be paid. So it's all based on the timeline of when a lien is placed against a person in a property. And that's why on a buyer side and on a seller, they look through those records to see if there's any other liens, because once the home sale closes and title goes ahead and files that paperwork, the timeline is stamped. So if there was a judgment prior to that that was filed, or a lien filed prior, it will get automatic first possession on the home, and then the bank gets second. No bank is going to close with second. That's why typically when a client does a cash out refinance and they have a first loan and then they have a home equity line of credit and they want to combine it, so they do a cash out refinance and they merge both of those loans together so that they now only have one payment. The reason they do that is because if they just paid off the first loan to refinance, but they didn't pay the HELOC would have automatic first position. Do you see how that would work? You'd get home purchase was filed, then the HELOC got taken out later and was filed against the house. if they did a cash out refinance, it would go right here in third position. And then the first one's gone. So the HELOC would get first position and then the house. So banks will never, ever put themselves in that position where they can't get paid. So we can't figure out the buyer issues until, unfortunately, we're under contract. So those things do come up, and sometimes they're total showstoppers, and sometimes they're fixable. So just depends. One of the other weird ones that I saw is that once there was a judgment against one of my clients, it truly wasn't his judgment. It was a family member's, and he was able to prove that, and then the courts cleared it. And then another one that we had that I remember really well was a really old child support order. It was probably 10 years old. And the client had paid all of that and more, and the child was way past 18. So he just had to go to Washington State child support, get evidence of that, and then they were able to actually file that with the county courts and clear it. So there's things that we can work on, but the biggest one that you can prevent is the seller side up front. The buyer one, it's a surprise. Home inspections is a big one right now. I think part of it is just like we always experience when it's more of a buyer's market, is that they're going to be a lot more pickier on the home. Maybe it's not such a big deal that the air filter is dirty, but maybe it's enough that it freaks the buyer out this time and they walk away from a house and get back their earnest deposit and then go find another one. So to protect your sellers, a couple of things that you can do up front. You can talk to the sellers about if they want to do a pre-inspection. Of course, as you know, they've got to disclose what's found on there. And then if they fix anything, they just keep those records and then they can present it to the buyer. So there's less likely of a chance of the buyers coming back and asking for repair costs or items to be fixed, because chances are they're probably not going to spend the money to go get another inspection if everything is a legitimately well done inspection and everything is outlined and major issues are taken care of. So that's one way that you could prevent that. Another thing to keep in mind too, and we are starting to see this more, is a lot of offers that are going out right now. They're going out with the purchase price and immediately asking for seller concessions. And it could be 2% or 3% to help pay down the interest rate, whether it's temporary or permanent, or pay closing costs. Because right now buyers have that strength in the market to ask for those things. So one of the big things that you need to keep in mind is that there's limitations to how much a buyer can get in total concessions. And those concessions are on the lender side, the seller side, and all the agents. So for example, client, let's say, is buying a conventional home. They're coming in with only 4% down payment. Because they are coming in with less than 10%, the total maximum package concession between the lender, the seller, and all the agents combined has to be less than 3% of the total loan amount. So that's part of the qualifying rules. And every loan program has little tweaks. Conventional is the only one that is the bigger tier step. So as the buyer comes in with a higher down payment, the tier of what they can get in concessions increases. So I'll put a chart out there so that you have it for reference. VA and FHA are really phenomenal programs. And again, another reason why I really love VA. So on a VA loan, there's actually, so your client's coming in, let's say 0 down payment out of their pocket because they're purchasing it using their VA benefit. So they're not coming into the transaction with any money. They could potentially get 6% concessions, depending on how they're going to split it up. One of the creative ways that I've done in the past is we use some of the seller concessions to buy down the rate. We use some of the seller concessions to pay the closing costs, and that chunk together was 3%. Then we used another chunk of the seller concessions to pay off my clients' credit cards. They didn't need to pay them off to qualify, but because there was repairs that were required on the house, because they were going at the higher price that the sellers did ask for, they were smart and negotiated these things, and we got their credit cards paid off. So there's flexibility with programs too, with FHA and VA. In both of those scenarios, I think it was FHA, We've even had sellers pay a judgment so that the house could close because the percentage of the concessions is a higher percentage than on a standard conventional. So just keep that in mind as you're putting in offers right now. If you're asking for 2 or 3% upfront in the purchase price as a concession and your client's coming in a conventional loan, if they're coming in asking for 3% and they do a home inspection and they want to ask for money, that money is not going to end up with them. That money can't get paid to them because they have too much in concessions already. If it's VA, FHA, call me. I can help you figure out what those percentages look like. So make sure you know that going in because it's a different market right now and we're getting concessions. Appraisals are a really big one that are causing, not causing too many issues yet, but I do foresee it being a future potential issue. So with appraisals, appraisers, as you know, use market data of recent sales within that community, same type of home and stuff to get a true value of what that house is going for right now in the markets. And so if that neighborhood didn't have very many sales at all, and they've gone back in time a bit, and then they extend their radius and look at further markets around it, you might find that your appraised value is less than you would assume it would be because it's harder for the appraiser to really prove that that value of that home is what you're estimating it at because there is no comps that actually back it up. So on a seller side as the listing agent, really easy, do the math, do the work up front when you're meeting with the clients. And sometimes you're going to lose clients. And I absolutely get it because it happens to us all the time. I will quote a client honest interest rates of what they're potentially looking at right now. They will go and shop other lenders. Other lenders will lie, give them crazy interest rates that nobody really is having. Clients aren't locked and they're told you're not locked. And then they get under contract and then those lenders say, whoops, the interest rate went up. It's actually this, which was the real one I was telling them. So I get it. Being honest with your sellers doesn't always mean, unfortunately, that you're going to get the deal, but it solves that issue of contracts falling out or houses sitting too long and not selling anyways, or really pissed off sellers when you can't get their house sold for the point that they wanted. So do the research, do the comps, pull the information, educate your clients. And if they really don't get it, maybe that's a deal you got to walk away from because it's not going to help when that appraisal comes in really low. And it's a very good chance all parties would walk away because if your sellers are being that specific about the point that they want on the house, they will see this market as a point that they won't bother coming down. They'll just walk away from the deal. And typically buyers right now, they're not coming in over us or over appraised value. So they're going to walk away. So do the homework up front. If you're a buyer's agent, do the homework up front, go through the comps, talk to your clients and have a realistic conversation. If they want to offer 60% less than listing price, don't waste anybody's time. Communicate with your buyers that that's just not happening. If they really want to write it, of course you have to, but know that that's not going to close. That transaction won't even happen. Key points about appraisals. Again, VA, my favorite. When it comes to an appraisal on the VA product is the only appraisal process where if the value of the sales price is going to, so far, based off what the appraiser is looking at already, looks like it's going to be less than sales price, they will call Tidewater, and it gives the lender a few days to work with both agents to figure out what the comps are and supply the appraiser with good, real comps to support what they feel that the sales price should be. The appraiser will take into consideration all the comps you supply, all the comps that they find, and then they'll research and make a decision. That is the only program that does it. One of the misconceptions is that if a VA buyer walks away, the VA stuck, that appraisal is stuck to that house, and that's not the case. A VA appraisal is stuck to the veteran of that address for 6 months. So if Monday a deal falls apart because of the appraisal with one veteran, Tuesday a brand new a veteran comes into the house, purchases it, does an appraisal, it's a whole different appraisal. So it does not follow the house, it follows the veteran for the house. FHA appraisals follow the house. So on an FHA appraisal, as soon as the FHA number is pulled from that house and that appraisal is done, it is in the system, stuck like glue to that house for 6 months. And aside from the appraiser making a huge error, like completely wrong on square footage, wrong on bedrooms, took pictures of the wrong house, you are not going to get FHA to reconsider that appraisal unless it's an error. So know that going in. Conventional, we don't even hear from the appraiser. They go out there, they submit the appraisal, and it's done. That one, if the buyer and the seller all agree that they don't agree with the appraisal, they can order another one. So different loans, different programs. Know those though with what kind of buyer you're accepting, and then know going forward, either as the listing agent or the buyer's agent, what does the comp support? Because as we transition into a different market, we're going to see home values fluctuate depending on where they are. One of the big ones is the loan process itself. This is why you must be an advocate for your lender. This is why you should only tell clients about lenders that you know, like, trust, because they actually do their job and they get how to do financing. It drives me nuts when I work very hard for clients. They go out on showings with an agent. I tell them what their maximums are and that there's no wiggle room. There's no any outside the box thinking that I can do because of whatever regulations or whatever ways that they qualify. The agent suggests that they go and talk to more lenders. They go and talk to more lenders who, no surprise, want a paycheck. So they tell them they qualify for what they want. Everybody gets under contract, and guess what happens? It falls apart. When you work with a good lender and a good lender says, I can't think of a single way outside of these parameters for your client to squeeze more house out, it's probably not happening. Most lenders have almost the same interest rates, and they typically have the same closing costs. And that's where the type of lender comes into play. A smaller lender, you're going to notice, you can even ask them, do they charge an origination fee? They usually will charge the same closing costs as everybody else, and they will add a 1% origination fee of the loan amount additionally. So the smaller lenders tend to be more expensive. Banks tend to be a tiny bit cheaper on the closing cost, and very much longer on the closing time frame. And then the hybrid lenders, they're super competitive, so they're right in that middle marker. Brokers, it's all over the place depending on the company that they chose the rate for. Quite typically, lower rates in a high interest rate market tends to mean much higher closing costs. So just know that those are how that works. But it's really important to have that total transparent conversation with the lender and with your client, and make sure that the lender knows what they're doing. If you've got some obvious red flags, like the lender's not calling you back, the client has no idea what they qualify for, the lender hasn't asked for them any of their documents, the client even hasn't had their credit pulled yet, those are huge red flags. That loan is not actually pre-qualified. Nobody's even looked at it. So good lenders don't tend to mud up underwriting. I hear that a lot, especially when we start to get into competitive markets again, where people are like, have you had it pre-underwritten? If you're a good lender, you tend not to do that, because anytime that we add additional fluff for underwriters to review, it means that they're slower on actual deals that are closing. So if I have a concern about somebody, they have variable income, they have a less likely credit history, maybe we have to do non-traditional credit on them, that's when I will package it up and send it to an underwriter. Prior to that, I know what I am doing. So I'm very confident on what that client can do, and that there's buffer room in case they get a higher than expected property taxes or things like that. So look for those things, know the difference between all the different types of lenders too. So on the bank side, that lender, that loan officer might not actually be a seasoned loan officer. So when you work for a bank, you don't have to go and take the bigger NMLS test. You don't have to pass that because the bank carries your license. So typically newer loan officers go on the bank side. They also get paid a salary and then a very small commission. So they're not so much in a hurry if a loan closes or doesn't, because it doesn't really affect their paycheck that much. So they don't have that same push and pull to get things closed. On a broker side and on a seasoned loan officer side, both of them are quite typically seasoned. Both of them typically know what they're doing. Both of them are typically 100% commission only. So they really want the transaction to stick. So they do a very good job up front, quite typically, of making sure they know what they're doing and that loan will actually go through, as opposed to throwing it out there and praying that it sticks. So how you can protect both your buyers and sellers in this case is advocate for a good lender, know who the lender is when you're accepting the buyer's offers, have the conversation with the lender, find out, just from your kind of your gut reaction when you converse with that lender, is how good are they? Do they have any concept of if it's a good file or not? All lenders are going to say, hey, I've done everything looks amazing, we're good to go, we just need a contract. Kind of ask the lender things like, is it going Fannie Mae or Freddie Mac? Have you put it through the underwriting automated system? Are you concerned at all on debt to income ratios? They can't tell you a lot of stuff, but they can kind of give you some indicators if the clients are kind of at their maximum, which could be a threshold issue, or if the clients have wiggle room, which doesn't mean that they want to purchase more, but then that means that on paper, it's easier for them to close and finance. So just be strategic when you're having that conversation and ask good questions. So we're getting pretty close to already half an hour, so I might put this into a part 2, but those are some of the really big ways that you can bullet proof your transactions so they don't fall out. If you have any questions, let me know how I can help you, and let's get you paid, because that, at the end of the day, is what you are here for. We are all here to make sure that you get paid.